Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting the monthly, once in a month, I give the twin webinar, that one during that of the European session and another one during that of the late European or the early US session. And during the first webinar time, I'll try to explain to you how exactly I take the market trading decisions using the simple market trading technique, and also how I try to close the position within the session. And I will show the results during the second session and explain to you what are the advantages of this sort of swing trades. So here we do very specific analysis, understanding what the players can do it in the market. The players can only do an upward move or a downward move. So we have to determine how much of upward and how much of downward move they are going to do it in relation to that of time. Because time is the one which none of the conventional technical analysis take into consideration and explain what could happen to that of the market. But ultimately, if the specified time is not given, then we find that we are not in a position to really understand what is going to happen in the market. And when the time gets prolonged, we become impatient. And once we become impatient, when the move is not happening, we try to go in for a distress trade. This is what's happening in most of the time. And if you see it in the networking of FX Trade, fxtrade.net, you come across that various traders simply follow others' calls and try to take the positions. And later on, they try to say that, okay, everybody was telling that the euro and JPY will come down. I have taken a sell position where it has gone up. So what is wrong with this? So this is how they tend to ask the questions, because they think that when the call is given immediately, which is expected to happen, and nobody has specified the time frame. So as a result, then when the time passes, immediately the trader who has followed it and tried to take the positions based on the recommendation find that it is not happening in the market. So ultimately, we have to keep our market tracking technique as simple as possible so that we can review it from time to time. And also we follow the time frame of the market and try to understand how exactly we can take positions and make profit out of that. So in this entire system of tracking the market, I'll be using only the live market quote page as a simple tool. In this live market quote page, you come across the bid ask, high, low, and the net change of the respective currencies. The four majors, Euro, USD yen, GBP, and USD CHF. And the two commodity pairs, namely USD CAD and Aussie Australian dollar. So these are all the six pairs. We will be able to follow it using the live market quote page. It is very similar to that of watching the tick chart. But when you watch the tick chart, it becomes unwieldy because continuously it makes the move and we are not able to do any sort of understanding of the market. So invariably we go in for a time frame of the chart like 5 minutes, 10 minutes, 15 minutes, or 30 minutes, 4 hours, etc. So in that, what happens, the chart is taking the average of the levels what are shown by the players and try to show the candle or a dot, depending upon the type of chart you choose, whether it is a line chart or the candle star chart. So after that, placing all the levels, you find invariably the high what is shown in the market quote page may not be shown there, because near that of the high, the market would have stayed only for about 1 second or 2 seconds. So in such a situation, what happened? It will be always showing a high just slightly lower than that, where the market has stayed for about 5 to 10 seconds or about 15 seconds or so. Because we go in for the compromise, or we'll go in for the average of those levels. So the charts tend to give the levels which are slightly different from the actual highs and the lows in the market. And secondly, what happens when you use the chart, it shows the candle, and when the spread is very low, Like now, here in the case of euro, 1.3668 is the high, 1.3640 is the low. So you find only about 28 pips. If you look into that of the chart, you'll find for 28 pips, the candle formation will be slightly optimal, but the spread, if you look into it, it will be only about 28 pips or 30 pips. And suddenly, when the market makes an upward move or the downward move, the chart becomes widened and you find the candle becomes bigger because it has to accommodate a bigger spread of 70, 80 pips. So when there is a consolidation, you find that the chart try to magnify, and when there is a sudden spike in the market, it shrinks the chart and try to give importance to that of the big moves happened in the market. So, which invariably trigger your emotion because from that of the magnified chart, when it comes to that of the reduced chart, immediately the candle looks very big, unusual. But if you refer to that of the pips change, it might be hardly about 30 pips on the side. But nobody refers to that of how much of pip change has happened. Instead, they're going only for that of the size of the candle and which triggers the emotion, and immediately the trader says, wow, what a big move it is. So immediately he is under the influence of emotions. Once he is under the influence of emotion and he is not able to take the appropriate decision. Because you know very well, there is a conventional saying, any decision which is taken under the grip of emotion is wrong. So under the influence of emotion, we try to take any decision with regard to trading. Either if you, after seeing a big green candle, we think that we can go in for a buy and sell trade, it might look long. Or sometimes you think that, okay, we can short there, probably they may continue to rise the levels. So you are not in a position to judge in relation to that of the time. So ultimately, what is more important in tracking the market? We need to have the live market quote page, and also we need to have the time. Unfortunately, here it shows the Eastern Standard Time, and I have got the GMT time frame here because the stock market is of a 24-hour cycle. So we need to follow it using the GMT time. GMT time is a 24 hours time frame. And then you have to identify how exactly the players have split the market and then try to track the market. So as far as my tracking technique is concerned, I got three elements. The first one is the derived forecast. The second one is the market reading. The third one is the trading strategy. So as far as the derived forecast is concerned, I had developed a statistical algorithm which is not taking into consideration any of the components which are involved in a conventional statistics or a statistical analysis of the market or a technical analysis of the market, and with which I am in a position to give the forecast for the market for a long period of time. And that I present it here on every Monday. On 26th Monday, I have presented what are the expected market moves in this particular week. So here you come across that today is 27th. Yesterday I presented it, and today is 27th. And this is the expected market move. And here you come across the session timings. So what are those sessions? So the players, depending upon the bank opening and the closing in various regions of the world, have divided the market into three sessions. And we can conveniently call it as a Japanese, European, and the US session, or session 1, 2, and 3. And the timings followed by the players are 0030 GMT is the Japanese session, and 7:30 to 13 GMT is the European session. We are now at 9 GMT. That is 1.5 hours from the start of the European session. And later on, it gets over by 13 GMT. I'll come back by 13 GMT. And 13 to 13:45 GMT, I'll be giving the part 2 of the webinar. That will be the closing of the European session and the gap time between the European and the US session, and the 15 minutes from the start of the US session. And so the US session gets over by 20:30 GMT. So here, for each session, they try to make the moves like this. And we need to understand how they are making the session-wise moves. So invariably, we need to track it. And for that, a gross forecast is given. So on a Monday, how exactly the Friday the market is expected to make the move is given. So you'll be able to find out what going to be the trend. Accordingly, we can take positions in the market. So this is the forecast. Then subsequently, you come across the market reading. In the market reading, what we do is, with the help of the live market code page, we note down the initial lows and the highs set for the day around 3:30 GMT on a daily basis. So today I noted down by 3:30 GMT the initial lows and the highs set in the four majors and two commodity pairs. So now let us compare it with that of the live market code page. You have formed the low 1.3643 as the low. Now you find that they just breached the low. 1.3640 has become the new low and started gaining the levels. So 3645 is current trading level and 1.3668 is the high. So they are not breached the high set around 3:30 GMT even during the European session, and which is set around 3:30 GMT of the Japanese session. Then in the case of GBP, 1.6838 is the low. They are not still breached it, but even though it has come closer to that, and 1.6869 is a high, and they went up to that of 1.6882 and come below. That means what? They set the initial low and the high, and then initial low they just breached and gone about 13 pips from there and started making the slide. So they are very cunning. So the players are very cunning. They pretend as if they are going to rise and then drop. And they pretend as if they are going to drop and then rise. This is what they do every time. Only then the traders get deceived and lose the money. So what you come across here, they just made an upward stop in the case of GBP to create the bullish field or induce the traders to go in for a breakout trade. But they did not sustain above that of the initial high for more than 30 minutes. Then we conclude that it is a stop point. And then later on started making the slide, and they are going to breach the low soon. Then in the case of yen, 101.89 was the initial low. They just breached and gone below and formed the new low, 101.73. And still holding below that of 101.89. So they are likely to make further drop in the case of USD yen. And before that, what they had done, they just made one pip upward stop and 101.99. They went up to 102. And so that the traders might think that it will jump up. And then when they had taken the position, simply they started making the slide. So it is a clever game in the market. Making a small swing on the upside or the downside does not change the economy. And if that does not move, then you think that the market is in a holiday mood and which is not making any move. And so you don't commit any positions. So the players have got the responsibility of attracting you. It is something like a gambling den. When you go to the gambling yard, you find that there are some people playing already. And you find that they are accumulating more and more of money. And you get tempted and you also try to bet. But actually, those who are making money in this gambling yard, they are all their own people. So when such people earn money, you get tempted and you also bet your money and lose it. So this is a trick of the trade. So here in the market also, they try to make the swings, keeping the bid as well as the ask. Alternatively, they just make the swings so that you find that the market is alive. And also you try to find that, okay, euro could go up or euro could come down, and you will be able to take positions depending upon your studies and understanding of the market and try to commit the positions. Once the traders commit the positions, they start making big moves on the upside as well as the downside. So till such time you come across subdued moves happening in the market. So in the case of CHF, they are not breached the low and the high, they have breached it and formed 89.58 as the new high and staying above that of the initial high. So we can do a buy and sell trade because they have stayed above that of the high for more than 30 minutes. Then we come across in the case of Canadian dollar, 1.0840 was the initial low. They just breached the low. 1.0836 has become the low and holding below that. Just now they just breached it and holding. We have to see for 30 minutes to 2 hours whether it is an extended downward move in order to make a breach on the upside. Then in the case of Australian dollar, 92.36 is the low and 92.64 is the high. They just breached 92.64 and went up to 92.78 as an upward stop and come below that of 92.64 and come to 92.62. So it was a stop and to come down below. So in the forecast, we have seen they're expected to make the swing that of the high, start making the drop during that of the European session. So now we also do the market reading, and that you find that they just breached they did not breach the high in the case of euro, but breached the low and staying above there, and they are expected to make for the downward move in the case of euro. So we will take a sell position in the case of euro, as well as sell position in the case of GBP, because they made an upward stop and started making the slide. They are likely to breach the low and come down below during the late European session. And our forecast as well as the market reading confirm the same. And in the case of yen, they just breached the initial low, staying below the initial low, so they are likely to come down. And if you see the net change here, you find already USDN and GBP are showing negative net change. It is a contrarian move, and soon they are going to drop euro also on the downside, and you will find all the three showing negative net change. That means it is a contrarian move on the downside. So you'll be able to do all the relative comparisons of the currencies, find out whether they are in the contrarian move or they are in the USD gaining or the USD weakening move. So simply by taking the position is of no use. They are going to drop euro. So already doing it. So probably I'll try to commit a position, then I'll come and explain to you, because of this, by the time you like to enter, there may not be any good chance. So I'll try to take a sell position in the case of euro. $1.3645, and with the order of 30 pips, there is entry stop. Nice stop. 30 pips above. In the case of GBP, they cut that low 68.38 and come below that. So a small pullback similar to that of, otherwise if they stay below that of 1.6838 for more than 30 minutes, that means they are going to drop it. At that time you can take a sell position there. So I'll keep the limit order. Just about 2 pips above, so there is a chance that it will get filled. So a buy stop above that is 1.6866. Then in the case of USDN, I told you that we can take a sell 101.87. And keep 30 pips hedge order. Okay, fine. So we'll take the position and also we'll try to take in CHF. $89.56 CHF. Okay, fine. So these are all the three positions I'm just committing at the moment. And so GBP now it is filled. So it is a sell position. So always, whenever they make a quick move, don't simply sell market and try to do like that. You just keep a limit order, they will come and fill it. About 3-5 pips away from it, you should be able to see that it is getting filled. And that way, no, you should be able to really fine-tune your entry. Okay. Now, these are all the three positions I just committed now. Then I'll come back to the trades later on. So a derived forecast, I explained to you, the market reading I explained to you. Then market reading, what you do is we note down the initial low and the high around 330 GMT in 4 majors and 2 commodity pairs and use them as a reference level because the players use them as a reference level for the entire day. And then we try to find out whether the market is moving above that of the initial high or moving below that of the initial high or the initial low. And accordingly, try to find out what sort of moves they are doing it in the market. Then third one is the trading strategy. So let me explain to you the market reading, that how to identify the type of moves. So before that, we need to know the market timings. So only if we know the market timings, we will be able to determine the type of moves because the moves are based on the time frame. So as I explained, the Japanese session is from 0030 to 7 GMT. Then 7:30 to 13 GMT is the European session. 13:30 to 20:30 is the US session. Then each session is subdivided into early, mid, and the late sessions. So early and the late sessions, they handle the majors, and mid sessions, they handle the crosses. So this is what's happening in all the three sessions. And in between the sessions where the bank huge orders do not come, you come across, they are called as the gap time, wherein the players such use specific orders to hit the stops. So you find invariably the false quick moves happen during the gap times. So once you understand the timings of the market, then we can understand the type of moves, what they are doing it. So if the move is for 30 minutes, there are two types of moves which can happen in less than 30 minutes, namely above that of the high, initial high, or below that of the initial low. They can just make a move for about 15 to 25 pips on the upside and quickly reverse in less than 30 minutes, which is a stop point. I explained to you, in the case of GBP, they just made the stop point. And then a false move is the one, they go up to that of the high. In the case of Euro, they went up to that of 1.3668 around 630 GMT, but did not breach it and afterwards came down. That is a false move. So they go up to that of the initial high or up to that of the initial low and reverse the market. And that is known as a false move. And it should also happen in less than 30 minutes. They are all quick moves. The stop and a false move or quick moves. So suddenly you'll find about 5-10 pips galloping and then they reverse just like that. So they are mainly to give the fear to that of the traders. So when suddenly the market jumps, immediately the traders think that something has happened in the world. Probably the world is going to come to an end. And this sort of imaginations the traders develop. And then look into various websites and switch on the TV and find out what is happening in the market. And later on find that there is a data release or somebody has spoken or some interaction has happened or that some event has happened. And that sort of information may be there. And sometimes a rumor was created and later on the market understood that it is nothing but the rumor, but the move has happened already. So when they make quick moves, immediately the traders become perturbed and they don't feel like taking any position. And the players know very well. So when they hold high, slowly gain and make an upward stop and the traders don't feel like selling there. They become afraid, then find out whether the market we can do buy and sell trade or a sell and buy trade. That's what they ask. By the time they ask all the people and come, the market has already fallen. This is what happens many of the occasions when they are not able to do their study on their own. So instead, it is a very simple method you can follow. and find out whether they had done a stop and sort of false move in less than 30 minutes. If they had done the stop and on the upside, that means they wanted to make a drop. And what they do is during the early session or as I explained with regard to the timing from 7:30 to 9 GMT during that particular time, the first 30 minutes, they just make an upward stop and then start making the slide. Sometimes they make that upward stop and during that of the late Japanese session. Afterwards, gap time, they make a small dip and form up and come up to that of the high and reverse it during that of the early European session. So in that case, we know it is a false move on the upside to make a drop afterwards. Then, if a move happens for more than 30 minutes up to 2 hours, so they cut the high and stay above that of the high and continue to cut the new high for 30 minutes and afterwards stop cutting the new high but stay above that of the initial high, then start making the slide. Then it is referred as the extended move. The extended move is for 2 hours. And again, it is a quick move. They quickly cut the high and go about 30-40 pips and stop there. And then after about 2 hours, they start reversing it, especially for the non-farm payroll. Last time when they released, what they had done it, they just came down quickly around 12:30 GMT up to 15 GMT. They have been hovering around near the low. After breaching the low, below the low, they just hovered around and then reversed quickly during the US session. From 14 GMT onwards, 13:30, the US session starts. From 14 GMT onwards, they started making the rise. It's a typical extended move on the downside and then start gaining the level. So you can understand that they are not going to drop for the non-farm payroll in a big way. Instead, they are going to rise. You can study easily by identifying the type of moves they are doing it. Always quick moves or false moves in the market, keep it in mind. Then the other move, which is a genuine move, that is the only move which indicates the intention of the player, namely the intentional move. This move happens for 2 sessions on the start of the 3rd session. So what they do is they cut the low, stay below. Now in the case of Euro, they cut the low and stay below that. In the GBP, they cut the low and stay below there for more than 30 minutes. Okay, that is the first condition. Or they cut the high and stay above the high for more than 30 minutes. Then slowly every 30 minutes cut the new low. Slowly every 30 minutes cut the new low. And make pip by pip downward move, or 1 or 2 pips drop and 1 pip gain, 2 pips drop, 1 pip gain. And that's that sort of moves. They do it in a very slow way and they don't give any level buyer the profit booking opportunity. And they continue to drop or slide for 1 session, 2 session. If they started during the European session, they continue till that of the US session. And the next day, the 3rd session, the Japanese session, they make 1 quick downward move and reverse and make an upward move. So that is the type of move they do it as the intentional move. Because they cannot continuously drop, what will happen? Everybody will start selling. And those who are sold at the higher level, they may not buy. And moreover, the traders will think that, no, I'm doing institutional trading. So as they drop, I'll continue to sell, continue to sell, continue to sell. Later on, find out that he has over-traded. And when they make 1 quick upward move, he will be attracted with a margin call because he has not calculated that in the event, if the market goes against me, what are the measures I am going to take? And if he has not got any contingency plan, then the players will try to give them a situation to do the crisis management. And invariably, the traders close all the positions. When they become emotionally take positions, once they become bearish, they continue to take more sell position. Once they become bullish, continue to take more buy position. There is a wrong approach to that of the market. And the players are here to punish only the emotional traders. And if you're a wise trader, you know very well the market is so big, I cannot withstand the pressure of the market. I will take only 1 position after doing all the reading, take 1 position and use the hedging to limit the risk. And once I book profit, I think of another position. If we have a commitment like that, no player can shake it. But invariably, out of greed, the traders try to commit more and more position, thinking that they can do the averaging trading. or accumulate more positions or a bottom fishing and things like that. Use various sentiments and try to commit more positions. Invariably, the traders lose money in the market because of over trading, nothing more than that. Not that they don't know how to read the market. Because in the market, suppose in the case of GBP, if somebody has taken a sell position around 1.6840 and another person has taken 1.6840 buy position, if they would have waited the sell position, they would have closed yesterday with a profit, and the buy position fellow would have booked the profit today. But if a person has committed more positions, when the market moves against, there will be a margin fear. So ultimately, understand the traders lose money because of committing more and more position beyond their equity, which can hold. And everybody is focusing on the forecast. But money management simply say that take only 1%. But we have to create a situation of that nature. Then we will be able to really understand how dangerous it is to commit more positions and lose all the money to the players when they are making moves. So what we do is we try to study the type of moves and we follow the session timings. So try to find which session they started. Okay, now they have started cutting the low in the early session and then start making that, keeping Euro and GBP below that of the initial low. So European and the US session, they are going to continue to slide. So we are able to find that because they are making a slow move on the downside. So which is convincing that they are going to make the slow drop. So we are taking the sell positions. Now, the third one is the trading strategy. Here I explained the trading strategy, because whatever be the type of forecast and whatever be our market reading technique, still as human we can commit mistakes. So in the event if the market goes against, why not we have a contingency plan of keeping the stop or the entry stop order or the buy stop or the sell stop. So otherwise nothing but the hedging order to limit the risk. Instead, if you take an open position and simply wait, then suddenly if the market reverses, then you do not know how to handle the situation. So there is no point in blaming the forecast. There is no point in blaming the market reading or whatever it is. Ultimately, you have to protect your equity. Ultimately, you have to earn net profit in your trade. Whether it is a right decision or a wrong decision, you should be able to earn out of that. And there comes your capability. There comes your skill set. Suppose you wanted to drive a vehicle, a car, in the highways, and suddenly you have to pass through a village. In the village, you come across narrow roads, and you find suddenly that there are some deep turns, etc. And if you simply say that, no, I know only how to drive in an autobahn, and I cannot drive in small villages or small lanes. Can you say like that? No, not at all. You have to maneuver it, and you have to slowly go and just have an experience of, in the event if the market goes against, how I am going to handle the situation. And one or two occasions, if you handle it by using the hedging order, and later on you find that it is a child's play. So use the trading strategy to limit the risk and maximize the profit. The trading strategy is very simple. So we keep a hedge order. So I explained to you that suppose I had taken a sell position, I kept 30 pips above a hedge order. And the hedge order in the same currency pair, which is available in many of the European trading platforms. But US trading platforms do not offer the hedging facility in the same currency, but some platforms are offering now. So in the event, if the market goes against my sell position, what they can do, it can only hedge my position. So when the position is hedged, you watch for about 10 to 30 minutes. And if you become a seasoned trader, within 10 minutes, you will be able to understand whether it was the hedging was filled during stop end or it was filled and the market is making a move against me due to various factors. So in the event, if the hedging is not making profit for more than 30 minutes, then you simply close the hedging order with a small loss and keep another hedging order of 30 pips and try to trial it to that of the original position until you are able to keep stop at entry and remove the hedge order. So we use the hedging instead of a stop, and also we use the hedging to limit the risk. At any given time, we take risk only for about 30 pips. And later on, we try to move the hedging order to that of the entry level and remove the hedge order. There, the hedging acts like a stop. Then the hedging is making profit. After the hedging is filled and the hedging is making profit for more than 30 minutes, understand the market is going away. It's just going in the opposite direction against my position. Anyhow, I limited the risk by hedging it at 30 pips. Okay, when the hedging is making 30, 40 pips profit and things like that, and you can find out what sort of moves they are doing it. They hedged it, and subsequently they are continuously cutting the new high every 30 minutes. You know that their intentional move is on the upside. So in such a situation, what you can do, you can simply close your original sell position and the buy position will be making profit. And you have to only earn 30 pips, the difference between the buy and the sell. Once the market moves upward another 30 pips, you are at break even. When they continue to make further rise, you are able to have a net profit on the upside. So the hedging is able to help you to reverse the trade by reading the type of moves they are doing it in the market. So in the event, if the hedging is really filled in a very quick move and they already gained about 150 pips, so nothing can be done because in a given day, they can only gain or drop about 150 pips. So in such a situation, when they stop cutting the new high, you understand, okay, the extended move is over and I can simply take a sell position. I mean, I can just close the hedge position with 100 pips profit and keep another 30 pips above the hedge order. And the next move will be the extended move on the downside. So when they come down, I'll trail the hedge order because they cannot continuously rise or continuously drop endlessly. They have to alternate the moves. So the next day when they start making the extended move on the downside, I will try to, I have booked 150 pips or 100 pips profit on the hedge side. When they come down, I'll close my sell position with 40, 50 pips loss. Or I take another sell position and close both the sell positions below their average with a net profit. Or I simply close lower the hedge order on the downside and until I am able to keep stop at entry on the sell side. So we have various options available for the either way trading. So ultimately, if you use the hedging, you're able to control the equity loss and also you are in a position to effectively handle this position and don't become afraid of the market moves. And then later on, you find the position is making profit. So now, in the case of Aero 1.3645, I took a sell and it is now 3642. Already, it is below that of the initial low. And in the case of GBP 1.36836, I took a sell, they come down 1.6817. So it is in the money and we will try to move the stop to entry and remove the hedge order once the position makes about 25 pips profit. And in the case of yen, which is almost around the same level, let us see how exactly they are doing it. By the start of the webinar, you know that they were only keeping USD yen at the negative net change, and slowly you find euro has become negative change, and also GBP has come under the negative net change. So now you can understand the market. We are able to really predict, what sort of moves they are doing it, and why not you learn it? And I'm not charging you anything. I'm just explaining to you free of cost, and you find if it is working for you, you make use of it. And There is no need even to tell me thank you, and you silently use and silently make money and be happy with it. That should be the approach. And I am not expecting any prize or reward for this. And what I want ultimately from the traders is understand that the men are acting against the traders. And when the men with the money power act against the small traders, and the small traders can only outsmart them and earn money. Otherwise, against the giant, it is next to impossible to earn money. So immediately what the people come to the conclusion is, in the market, 95% of the traders lose because they find that in the conventional technique, how smart you are in applying various techniques in your understanding, somehow or the other, the stops are filled. And immediately they think that, okay, it is next to impossible to earn money from the market. And only we can go in for a breakout trade. Many of the analysts have come to the conclusion of giving the call only with regard to the breakout trades or recommend scalping, because there you will be able to quickly earn about 10 to 15 pips or 5 pips and things like that. So ultimately, if you want to earn against the men who are trying to operate the market, we have to read their intentions. So in the financial market, if somebody wants to make money, and they have to be cunning, nothing more than that. So any of the fund or any of the investment arena, when you talk to any of the financial people, they will give a very rosy picture about the investments. And later on, when you just see the actual results of it, and they will simply say that switch from one fund to another fund. And I do not want to go into the details. And that is the only way in the financial market people can make money. So it is normally the institutions bring in the promises, the traders bring in, or the investors bring in the money, and they mix the promises with the money and later on share it with that of the traders. And that is the main objective of the financial institutions. So ultimately, don't be moved away with it of the promises. And you find how exactly the players are able to make the moves in the market as long as they are human, and beyond human imagination, they cannot make any moves in the market. So we should be in a position to read it. And you know that if somebody is really a good businessman, that means he is very good in reading the customer's sentiments and customer's requirement, whether he is able to identify the customer, whether he is going to be a prospective buyer or he is going to do a window shopping, and accordingly try to convince and sell the product. So ultimately, what is a need-based selling of the product is necessary. If the person asks for a discount, they will offer a discount. If the person asks for a gift wrap, and they will try to do it. So it reads the pulse of the customer. So similarly, we need to read the pulse of the players and try to take the positions. Then we'll be able to really have a win-win situation. And the players, if you keep a small equity and try to trade using the technique, the players are not going to be here to fill your stops all the time. And let them do the stop, and you have the hedging to limit the risk. So it is not the forecast. We try to read the market from time to time. And also we try to limit the risk using the hedging model so that we don't take an unlimited risk at any given time. So if you follow all 3 steps, and I am 100% sure that consistently you will be able to earn money from the market. So if you've got any questions, you can ask me. Otherwise, during the part 2 of the webinar, I'll try to explain to you or show you the results of these, what I have taken now, and how exactly I handled it during this particular time frame. I'll explain to you. So I'll come back by 13 GMT and then show you in part 2 of the webinar that how exactly the market has moved, whether against me or in favor of my reading. So if it is against me, I got a hedging to limit the risk. And if it moves in my favor, I got a strategy that I'll keep stop at entry and then I'll keep about 45 pips limit order. And if the going is good, I will try to keep 75 pips limit order and maximize the profit after keeping stop at entry. That is on the exit part of it. And in the event, if they hedge it, if the market goes against, then if it is hedged, I'll watch for 10 to 30 minutes. If the hedging is not making profit, I will try to close the hedging with a nominal loss or with stop at entry and keep another hedge order 30 pips above and try to move it towards that of the initial hedged level. So here what you come across is I got a plan whether the market, if it goes down or go up, I got a plan to handle it. So that is called contingency plan. Okay, no more questions. So I'll come back by 13 GMT and explain to you what happened to the trades and also explain to you how exactly we can continue to do the session-wise trades, reading the intentions of the players. That I call it as tracking the market using the live market code page. Thank you one and all. See you by 13 GMT.